You know, sometimes you look at a company's earnings report and it looks like an absolute home run. That's the story with ARC Resources. I mean, on the surface, you see record numbers, cash flow just pouring in, happy shareholders. But if you dig just a little deeper, there's a much more complicated story unfolding. It's really a tale of hitting a huge roadblock on a key growth project, and it's all about what a company does when its best-laid plans go completely off the rails.
And this is where the good news part of the story really kicks off. Look at that number, over 408,000 barrels of oil equivalent per day. Now that's not just a big number, that is a company record. It's a solid 7% jump from the year before. And believe me, this is the exact kind of headline that makes investors sit up and take notice.
All right, so here's our game plan for this explainer. First, we're going to dive into that incredible record-breaking quarter. Then we'll hit the big plot twist, the Attachie challenge. After that, we'll look at how ARC pulled off a really disciplined pivot, what made that move even possible, and finally, we'll wrap up with what their path forward looks like now.
Okay, let's kick things off with those historic wins, because really, before we get into the weeds on the challenges, you've got to understand just how good this quarter looked on paper.
All right, quick heads up. You're going to see this term BOE a lot. It just stands for barrels of oil equivalent. It's basically how the industry takes oil and natural gas and rolls them into one single number so you can compare apples to apples. Simple as that. Okay, with that out of the way, let's follow the money.
And wow, the financial growth here is just staggering. I mean, look at their free cash flow. That's the cash they have left after paying for everything. It hit 1.3 billion Canadian dollars for the year. That's more than double what they pulled in just the year before. And let me tell you, that kind of cash gives a company a ton of options. So the big question is, what do they do with all that money? Well, they send a huge chunk of it right back to their investors, which really tells you where their priorities are. A whopping 75% of that free cash went straight to shareholders. We're talking over $500 million in share buybacks, that's when they buy their own stock to increase its value, and another $500 million paid out in dividends. The rest, they used it to smartly pay down debt.
So, okay, this all sounds pretty amazing, right? Record production, cash flow through the roof, shareholders are happy. So if everything's going so well, what's the problem? Well, this is exactly where the story takes a very sharp turn.
And that turn leads us right to something called the Attachie project. This was supposed to be their prized growth asset, the next big thing, and it just hit a massive and very public snag.
Now, to really get why this is such a big deal, you have to know about the Montney Formation. Think of it as some of the most valuable oil and gas real estate in all of North America. And Attachie, that's ARC's crown jewel project, sitting right in the heart of it. It's condensate-rich, which is just a fancy way of saying it has a lot of valuable light oils mixed in with the natural gas. This thing was supposed to be the engine of their future growth, period. But then came the earnings call. And the CEO, Terry Anderson, dropped this bombshell. He said, and I quote, "Early results from our most recent Upper Montney pads are not meeting our expectations." Now, you have to understand, in the super careful world of corporate speak, that is an incredibly blunt way of saying, Houston, we have a problem. It's a huge admission that your #1 growth project is in serious trouble.
So what happens next is pretty fascinating, honestly. It's a real case study in corporate strategy. Instead of freaking out or trying to spin the story, ARC made a very deliberate, very disciplined pivot.
They basically laid out the super clear, methodical plan. Step 1, hit the pause button and adjust the whole development schedule. Step 2, let the tech teams really dig into the data and figure out what's going on. And step 3, get ready to move that money somewhere else. You see, this isn't a panic move, it's a strategic timeout.
And to show just how serious they were, they did something pretty bold. They completely pulled their specific production forecast for Attachie for 2026. That is a huge public signal. It basically screams, we are not going to rush this. We care more about getting it right for the long haul than hitting some short-term production number.
So you might be wondering, how can a company afford to just pause its main growth project like that? Well, that brings us to the real hero of this story, the powerhouse that is their core business. And this chart just lays it all out, plain and simple. Look at this. Attachie, the developing asset, was producing around 28,000 BOE a day. But their core engine, the Kakwa asset, it was churning out over 215,000. That massive, reliable production from Kakwa is what's paying all the bills. It's the financial muscle that gives them the luxury of being patient and getting Attachie right.
Okay, so what does the path forward look like?
Really, this whole episode boils down to one central idea: balancing risk today against creating value for tomorrow.
And get this is the real kicker. Even though they've hit pause on their key growth project, ARC's overall guidance for the whole company, for production, for capital, it's all completely unchanged for 2026. That just goes to show you how resilient their entire business is. That core is so strong it can take a hit from Attachie and not even flinch.
When you step back, you see that everything they're doing circles right back to this one core mission. Every single decision, pausing Attachie, moving capital around, it's all framed as part of a long-term plan to create value for shareholders, not just to chase some number on a quarterly report.
And really, this quote from the CEO just perfectly wraps up the whole story. He said, "I realize that sometimes the right business decisions are not necessarily the most popular. We are here to manage risk while we create long-term value." I mean, that's it right there. He's openly admitting this choice might not make everyone happy today, but he's betting it's the right one for the future.
And so that leaves us with the big question, doesn't it? Is ARC's patience here a sign of incredible, disciplined strength backed by a powerhouse core business? Or is it a red flag, a signal of deeper troubles ahead for the one project that was supposed to guarantee their future? I guess only time is going to tell.